We had a very interesting week in the markets, which led rates to the lowest levels in over a year before returning back up to exactly where we were about 8 days ago, which has led many people to ask, hey, did I miss my window to lock in an interest rate, whether it's a refinance or a purchase? Join us as we break down exactly what happened, what's likely to come next, and stay tuned till the end when I'm going to give you a very simple rule of thumb that tells you exactly when it makes sense financially for you to refinance your current mortgage. All right, so let's jump into this data. This is the bigger term view that we've been looking at. You can see that green down channel still absolutely intact. Actually, we're on the low end. We are outside of the range on the bottom, meaning rates are better than where we would have expected them. But you'll see that weird dip on the right side, and we're going to talk about that in just a minute of what happened and why rates got so low for just a minute and why they are no longer at that level. So we take a look. There wasn't a whole lot of data this week. On Monday, we had a strong ISM Services report. And after all of that movement from last Friday and very early pre-market on Monday, that's what started giving back. That ISM Services report is what started us pushing back up towards the range that we've been in for the better part of 3 months now. Why would that be? Because Friday and over the weekend, markets were panicking and thinking that the Fed needed to step in to do an emergency intermeeting cut. And by the end of the week, things had settled out. People had returned to calmness had returned to markets, and people were no longer calling for such ridiculous claims. And we're willing to wait until September for the Fed to do what they need to do in terms of cut rates, whether that's 25 or 50 basis points. So Wednesday and Thursday, we had weak 10-year and 30-year Treasury auctions, despite the facts that yields were up from the lowest levels over the weekend, which would generally lead us to believe that they should have been strong. But big picture, this was a pretty weak data week, so it's kind of interesting that we saw this. Now, let's go back and look. We had the Fed meeting last Wednesday. They said some things that the market took positively. That led to the first dip. And then Thursday, we had some additional weak data. And then Friday, really weak jobs report that made people think, oh my God, the Fed has lost this. They should have cut on Wednesday. They need to cut at the next meeting. They might need to cut before the meeting. Over the weekend, you may have seen headlines about the yen carry trade and the unwinding of the yen carry trade. All that means is it was so cheap to borrow in Japan that some investors were borrowing in yen, investing elsewhere. Well, as the borrowing costs have gone up in Japan, we see some of those investments having to be liquidated to repay those loans as those trades no longer make sense. We may have some more of that to go. Big picture doesn't really impact you on a day-to-day basis. Let's focus on that trend line. You see we are below the bottom green line. We are still outside of the trend. And I don't know if it was a week ago or 2 weeks ago, I had pointed out by September 18th, the bottom of that trend line should be at about 388, 387 on the 10-year Treasury. And I would bet when we get those Fed cuts that we're going to be somewhere near that on the 10-year yield. Well, we had hit 366 on Monday. We just got ahead of ourselves. So rates are still low. A week ago, everyone thought current rates are great. They are trending lower, and that's all that matters for you. Rates are good. Let's ignore that for about 6 hours late Friday and early Monday, they were much better because they're good and improving. Now, what does that mean? So on a 30-year fixed, Mortgage News Daily is reporting 6.54. That's up 0.14 over the week, an eighth of a percent in interest rate. It went from being really good to just good and moving in the right direction. Sensing a theme here, I'm going to keep talking about rates continuing to move in the right direction. FHA and VA rates, 6.09, 6.10. We were able to lock many of our best qualified FHA and VA buyers this week, well below 6%. So again, are these great rates relative to 2020 and 2021? No, but they're fantastic relative to where we were even 3, 4, 5 months ago. So let's look forward. We're going to get another piece of data next week. We get another jobs report. We're going to get another PCE report before the Fed comes back on September 18th. What is the market expecting? Well, we had gotten up to almost 100% chance from the futures market perspective of the Fed cutting 100 basis points in September. Now it's 50-50. Are they going to do 25 or are they going to do 50 basis points? Same thing for the next meeting. Most likely, we're going to get another 25 basis points from there. But between those two meetings, we got 50 to 75 basis points of cuts. And by the time we get to the end of the year, they're pricing in about 100 basis points of cuts, or expectations of 100 basis points of cuts. That is far more than what we are seeing on rate sheets today. And as long as things continue trending in that direction, interest rates will continue to get better. So really, next week doesn't have a lot of data either, but we got a really big one. The two big reports are the jobs report last week on Friday. And next Wednesday, we're getting CPI. So the headline CPI before they strip out food and energy was 3% last month. We're expecting that to drop down to 2.9%. The core CPI was 3.3% last month, expected to drop to 3.2%. If I were a betting person, those are pretty reasonable forecasts. If we miss, are we going to miss and be below that? Or are we going to miss and be higher? There are reasons to believe that we are seeing some of the catch up in that shelter inflation, reflecting more accurately what we're seeing in the market, which is lower inflation in rents. And because of that, when shelter costs come down and they're accurately reflected in CPI and the PCE data, we're going to see these moderating. And that is what the Fed wants to see. Lower inflation, slightly weaker jobs report, but not much weaker than what we're seeing right now in terms of employment. So with that, I hope that was helpful. I promised you guys a simple rule of thumb because we had so many people reaching out this week about refinancing. If you want to know how much you need to save, we have really old school rules of thumb that people talk about. Their grandparents told them, don't refinance unless you can save 2%. Well, that was from a time when rates or mortgages were $25,000 or $50,000, and you did need that big of a move. So we need a measure that takes into account the much larger loan sizes that we have today. The simplest way to do this is take $125,000 and divide it by your loan amount. And that tells you what rate savings you need to see on a 0-point refinance to make it make sense. So 125,000, if we divide it by your $250,000 loan amount, we need to save 0.5% for it to make sense for you. Now, if you have a $500,000 mortgage, 125,000 divided by 500,000, we only need to save 0.25%. You might want to see more savings than that, but that is really all it takes to justify a low-cost, 0-point refinance. If you have questions on refinancing, on purchasing, you want to get pre-approved, you just want to see a second opinion on the numbers you have to make sure you're in good hands, we're happy to do that for you. My name is Josh Lewis. I'm a certified mortgage consultant. I've spent 29 years helping people just like you, and we would love to talk to you. Thanks for joining us. We'll see you next Friday.